Welcome to Invest Northern Ireland's COVID-19 Response webinar series.
Good morning, everyone. I hope you're all keeping as well as you can be in these crazy times. My name is James Davidson, and for 14 years I've worked in the PwC restructuring team in Belfast. This means I've spent most of my career working with businesses in stress situations, helping manage through a crisis, conserve cash, deal with stakeholders, and try to return to stability and growth. Clearly, many of us are now facing such a stress situation due to COVID-19. There's a lot of worrying economic data out there at the moment, but it's still quite unclear what the medium-term impact might be and when everything gets back to normal, or perhaps a new normal. I think it's fair to say that none of us has ever seen anything quite like this immediate hit to business, with some being told to temporarily close, and even if they can stay open, there are severe demand and operational challenges. There are very few, if any, organisations, whether in the public sector, charities, or private within any industry, who will not be affected. So I'm hoping that I can share my experience and how we help others manage when cash is under pressure. I'll be followed today by Craig and Cara, who will discuss many of the external support options available to help you manage cash, but it's clear this support may not be enough to manage the crisis for everyone. Initially, therefore, I'm going to run through a few practical steps you can take yourselves to reduce any cash shortfall as best as possible. Okay, so first up, understanding your liquidity requirements. In our view, this is the first step everyone must do. You need to understand your cash requirements before you can take action on them. I appreciate not everyone will regularly prepare a 13-week cash flow, but at a time like this, we think it's absolutely essential. Once you have a cash flow model, you can use it for a number of purposes. You can use it to plan for the next number of months and be prepared for what's ahead. You can also use it as a checklist of options to consider how you can improve your cash flow. It will allow you to assess your funding gap, if there is one, so that you can then seek to bridge that. And finally, I expect you're going to be asked for it by a lot of your stakeholders going forward, whether that's the banks or HMRC. So the cash flow itself, create one for 13 weeks, 1 quarter. You might want to do it for 26. You'll want to keep it updated week on week, adding in your actual cash and 1 extra week's forecast, and continue to update it, especially for your view on COVID-19 and the changes that might be coming. For some, this might involve forecasting reductions in sales and your cash in, but it's likely that many of your costs may remain. When you do it first, it might show a cash outflow, but knowing how much is important. To prepare it accurately, you're going to need to understand potential impacts of COVID-19, model the potential impacts of COVID-19, and engage with your stakeholders to understand their situation. So first up, in terms of understanding the potential scenarios, you want to have a think about what these are likely to be for your sector. Nothing is clear, but if you read the latest guidance from either the World Health Organization, Bank of England, even PwC have models and scenarios planned to help you understand how this might pan out. I guess it's important to note that I don't think any of these are showing that we have a few more weeks of lockdown and then we're back to normal. So you need to realistically assess how this might look for you, both for the next 13 weeks and in the longer term. Once you've done this, you want to model these scenarios in your cash flow. You probably want to have an expected situation, an upside situation, and a downside situation. And in each of them, you want to assess the impact on your financial position and cash need, as well as the impact on your resource planning, operations, etc. Also, whilst you're doing this, you need to look forward at your stand-up plan and think about, in however many weeks it might be that things return to a new normal, how does this look like from a working capital aspect? So again, to do this accurately, you're also going to need to engage with your stakeholders. It's hugely important you can understand their position and how this will impact on you. For example, what about your supply chain? Will supplies come? Will contracts continue? Are there going to be delays? What about your workforce, etc., etc.? Again, you're going to want to model this into your scenarios because it's going to impact on how you run your business and manage your cash. Before we go on to what's next after you've prepared your cash flow, just a couple of quick comments on logistics and how you do all of this remotely or in a partial shutdown. Probably depends a bit on the size of your business and whether you're a one-person finance team or a large company, but you should consider 2 things. Firstly, to stand up a central point of control, basically a central control point for information to flow, where decisions can be made and issues can be escalated for decision. I've seen in a couple of other PwC slide decks that PwC are calling this a cash cockpit, but I really think if you must name it, you should probably choose something different. To help with this control point, you need to assess your central reporting structure. So what reporting tools and systems do you have? You need to work out a way to allow real-time reporting, the transfer of information across multiple locations, and access to the live data you need to make your decisions. Okay, so you have a cash flow and scenario plan, so what next? So next you want to use your cash flow to consider both cash, so you want to review every pound expected to go in and out of the business, as well as your profit and loss. So you want to review every future revenue and costs to improve your short-term profitability or minimize your loss. In terms of cash, you want to focus on the first 2 points there, so bolstering your cash collection and controlling outgoing cash. And I realize there's a bit of a paradox here, which I'll come back to later. With regards to bolstering your cash collection, we're hearing of sector by sector a number of issues where cash payments are drying up, and it might not flow through to you if you don't chase it. So you want to be proactive here. You want to assess your customer payment risk. Are your customers impacted? Are they shut down? Can they even process a payment run remotely? And then target in on the highest risk payers and focus on proactively collecting cash from them. Again, don't just assume it's going to flow through to you. So you want to speak to your customers. You might need to consider offering early payment discounts. You need to have a plan in place to deal with disputes or requests for information to get invoices paid. Slight aside there, for anybody who's on invoice discounting, I guess just be mindful that if those payments do not come through on time and become aged, there's a potential that they could become ineligible for your invoice discounting. And if you're concerned about that, you should speak to your bank. In terms of controlling the outgoing cash, ultimately, if you're in a distress situation, you may need to potentially delay some payments going out. If this is the case and you are struggling with cash, you'll want to classify payments as critical and non-critical. Some of them you might need to defer and not pay on time. Many have not done this before and will be used to paying everybody when they're due, but it is required if you're in a distress situation. There's a trade-off with the relationships, but crucially, you must engage with these stakeholders and explain to them the issues that you're having. Crucially, do not put your head in the sand and just avoid phone calls and don't make payments. I guess a few examples of this is you might want to speak to your landlords about, say, a rent deferral. Conscious there might be landlords on this call, so be prepared for these asks coming through. And there may be a need to share the pain between landlord and tenant. You might need to speak to suppliers if they've provided goods which are stuck in your warehouse and you can't sell them. And you might want to talk to them about deferring the payments of those until you can get them sold. You definitely want to speak to your bank about deferring capital payments, and also HMRC, which Craig will talk about later. Again, you should speak to them all, talk to them, engage with them. It's important too that all of your stakeholders feel they're equally part of a solution. So don't just go to your landlord and ask for a rent deferral if you haven't done something similar with your bank and HMRC. It's important that they all play a part. There's obviously a contradiction, as I mentioned at the start, about if everybody on here is trying to bolster their cash collection and control outgoing cash. And if everybody does that, obviously there's going to be a real slowdown, and it's important that that doesn't happen. I think the important thing is to just be mindful of other people's positions. Use your own judgment and only defer things if you're genuinely in distress. You need to communicate with your stakeholders because we're all only going to get through this together. So we need to agree what's practical and fair. As noted there, so there's external support functions, and these are going to massively help on cash here. These are going to be covered later. For the cash in, there's the job retention scheme, the business interruption loan. For cash out, there's time to pay, rates relief, and various others. Make sure you explore all of them. We're also finding out, however, that there might be a delay in some of these coming through. So some of the steps we've just talked about might help you manage cash while you bridge the gap and you wait for those support functions to come online. Remember, there is government-backed loans, which Cara is going to discuss, but they are loans, they are debt, and they need to be repaid. So you want to be doing everything you can yourself to try and minimize what debt you need to take on and protect your balance sheet. So you've looked at all the cash that's due to flow in and out already, but also you want to think a little bit ahead and look at your costs going forward. So you want to look at identifying your cost reduction opportunities and minimizing those costs. Examples of this might be you might need to think about delaying capital expenditure, consider cancelling non-essential orders, maybe selling assets or running down stock. If you're trading at reduced capacity, you might want to rationalise shift patterns, temporarily downsize parts of the business, or build up your support functions from a zero base. Do you really need the full level of support functions for the level of operations you've got at the moment? Fortunately, the furloughing workers scheme will come in and is an option that means that people can still get paid whilst you're going through these temporary solutions. They'll be different for everyone, but you should definitely think them all through. Finally, then you want to link all of these thoughts and options through to your short-term cash flow and update it for what you can do with the aim to minimise any short-term loss, minimise cash going out the door and reduce any funding gap. And do all of these before you jump into taking on more debt. So in summary, what we're suggesting is make a cash flow and a scenario plan. Do everything you can, protect yourself in the short term with regards to your cash in and cash out. And do all of this through open and consensual communication with your stakeholders. Finally, for me then, as we're talking about distress conditions, Invest NI have asked me to touch on directors' responsibilities and insolvency. If you're finding yourself really concerned about insolvency, please do speak with a professional. There's rules in place to protect the interests of creditors in these situations, which directors must follow if they're concerned about insolvency being a possibility or a strong possibility. If they don't follow these, insolvency law exposes directors to personal liability for wrongful trading. Now, these are being temporarily relaxed. However, there's a few key suggestions if you are facing real concerns about solvency, which are still relevant. Those are listed on the slide there. So first off, have a clear view of cash flow. Bear in mind how you will meet your future liabilities, and our previous discussion will help for this. It's another reason why having a cash flow forecast is important. You want to evidence your decision making, ensure you document all the key decisions and considerations around how you trade going forward, and be wary of incurring new liabilities and your ability to pay these before you take on credit or fulfilling orders if you're taking on customer deposits. Basically, don't rack up large liabilities that you don't know how you're going to pay or make creditors worse off, either individually or as a whole. As you go forward with your cash flow, you should regularly consider whether it's appropriate to continue to trade. And the main thing here to do is to make sure that you have a recovery plan for how you're going to turn around at the end of all of this. The simplest rule is to seek professional advice if you're in doubt. A restructuring lawyer or an accountant can help talk you through if you've got concerns. Finally there, you may have just heard reference to a couple of announcements in terms of changes to insolvency legislation, so it's worth a brief mention. The wrongful trading rules have been temporarily relaxed, but to be honest, these are rarely followed through, so therefore the changes are more to give comfort, I think, than anything practical. Key is just keep doing the right things and take advice if you're concerned. The government's also accelerating changes to insolvency law, and you may have seen that announced over the last couple of weeks. These have been in the making for some time, but they're probably going to be pushed forward with an aim to give more opportunities to restructure a business and allow directors to continue trading, protecting jobs whilst they work out their options. Again, though, a lot of this is to be confirmed. It's not going to come in down the line, and we're still not even 100% sure that it's going to be applicable in NI. So again, it's not something you need to massively worry about at this time. So that's broadly it for me. Apologies for ending my piece on a downer. I definitely didn't necessarily want to open with that piece with a reference to insolvency. However, I can now hand over to Craig, who's going to be much more upbeat and start to discuss many of the support packages that could be made available to help.